4999. I'm laughing a little bit because what does 5% mean, right? Can it go higher than that? That would imply, it seems, not only prolonged delays here in rate cuts, but something else going on with inflation.
Clearly, Sonali, I think what we're seeing here is, and I'm starting to get whiffs of stagflation, dare I say it. I know that's like a dirty word in a lot of circles, but
probably necessary to talk about right now.
It kind of is, right? We ended up with a GDP print that was far worse than expected, 1.6 when we were looking for 2.5 versus 3.4. That's terrible. And you had a worse PCE number yesterday, which of course is not the PCE number, but a PCE number. Well, if you have a weak economy and inflation that's not coming down, you kind of have to think in those terms, and that's why it was kind of shocking to see bond yields rise on a day where GDP was a big miss. So it has to be that other inflation nervousness.
So is now a time for caution? I mean, how should I feel right now, Steve? I look at all this economic data. It seems to just say that basically inflation is still sticky. It's still high. Stocks are rallying. Yields are, doing what yields are doing. How should I feel?
You should feel concerned a little bit. I think the time for just closing your eyes and buying anything is done. I think that ended sort of on March 31st, or maybe call it April 15th, just around tax day, when people actually who made a lot of money in 2023 took some profits, which is why you saw Nvidia and some of these other stocks pull back. But I think right now you have to start to wonder, the push-pull between stocks and bonds is getting a little nerve-wracking. I think we were able to ignore it for most of the year so far, partly because of just the weaponized FOMO that was in the stock market, buy anything, partly also because of the reason that yields were going up, which is a stronger economy. And on balance, stocks do like a stronger economy up to a point. The bond market starts to freak out a little bit, and we've gone from sort of the bond market just sort of rising because the economy's getting better to now the bond market's starting to get a little stressed.
How do you feel about some of the complacency in other parts of the bond market? You think about where people have really placed their money earlier this year in pretty risky wagers, frankly, assuming that there's really almost no rollover in maturities here.
It's actually quite astounding how many of the strategies that worked really well in the, let's say the 2020 to 2021 period, the money flowing everywhere strategies are still being employed now, and yet they're still working. That's one of those things.
When do they stop working? I mean,
that's the problem. That's my point to Katie, is maybe we need to start getting a little more concerned about some of these things that are underlying it, because the spigot is not on full blast anymore. It's not turned off, but I think some of these, we're still hunting yield incrementally. We're still hunting excess returns, and they should be getting harder to come by. Fortunately, so far they're not, but that gets the nervousness in.
Isn't it funny that people still have that yield-seeking behavior? They're funding into, of course, risky parts of the bond market. When you take a look at cash right now, earning 5%. Actually, Bill Gross, he tweeted the other day, why bother with bonds? T-bills are at 5.25%. Seems like a slam dunk there.
You're speaking to someone who has too much money in money markets by a lot of people's point of view. But yeah, it's the same basic thing. Think about it this way. We went up 10% in the first quarter, S&P, which was fabulous. Can you annualize that? Are we going to be up 40% this year? I'm going to say no. So at some point you get the back and the fill, and when you're getting that back and fill, when you're getting some of the volatility, it's not the wrong place to be if you can actually earn a real rate of return on cash. It's something generations of investors have just not been used to. And I think we forget about that sometimes. Bill Gross, having the perspective that he does, says, okay, there's nothing wrong with just, parking your money if you can make some profit on it.
This whole idea of where's the risk, we were talking about some of the steam coming out of some of the favorite trades, but the question is, how much drawdown risk is there still, especially going into a big Fed meeting, a big payrolls print, and potentially a new economic environment?
I think the drawdown risk can be substantial in terms of we didn't complete a correction. It felt like we corrected, but we really were down, call it 4 to 5%. Certain stocks had big corrections, but as a market as a whole, we didn't really complete that correction. It's possible. I'm not necessarily saying that's the base case. There still seems to be this underlying residual momentum in earnings season. We've gotten our requisite 80% of stocks beating estimates, so that seems okay. But that would sort of be my point. It's to say this is not out of the question, because it's really finishing the correction is really down another, call it 5 to 6% at this point, which is not historically unusual.
And you really know it's been a crazy week because I actually had to check as to when Tesla reported, and turns out it was 3 days ago. Can we talk about some single names here? Can we talk about Tesla a little bit? You write in your notes that finally maybe we're starting to see some genuine risk aversion priced into Tesla shares. I mean, what do you make of what we heard, of course, on the call?
It just shows you what a wacko stock Tesla is and how faithful. I've called it a faith-based stock for years. And any other company, if it put out numbers like Tesla did, would have been shredded. I don't even want to put a number on it, but it would certainly double-digit down. But Tesla investors are always looking to the future. And so, let's talk about robo-taxis. Let's talk about, a $25,000 car that may or may not actually be coming to market. But if you put enough futurism in front of the Tesla investors, that is what gets them going. The reason the stock rallied also was because for the first time in ages going into earnings, we actually saw the options market pricing in some real risk. And what we learned this week was the option market was a good contrarian indicator. It was showing a lot of risk for Tesla. Tesla went up. It was showing not too much risk for Meta. Meta went down. Because of Meta, it was then pricing in a lot of risk for Alphabet and for Microsoft, and they were fine.